Don't worry about that though. I won't put you through another one of my rants here. And instead, I'll show you the conversation that I had with Justin Huhn, who's called the Uranium Insider, on what happened in uranium this week and where he thinks that we might be headed. Let's watch.
There's a number of things that kind of converged. One is that SPUT was and still is relatively quiet. They actually did purchase 100,000 pounds yesterday, drawing their cash down to just over 20 million. Typically, they've been holding 30 plus million in their treasury just for a rainy day, let's say, to cover G&A. But they did buy a little bit of pounds. But for the past 3 weeks or so, they've been mostly trading at a discount to their net asset value, haven't been raising cash, haven't really been buying that much uranium. I think they bought 600,000 pounds in the past 3 weeks, which is, a decent amount, but relative to what they had been buying, they've been pretty quiet in the market. Year to date, the Sprott Physical Uranium Trust is about 50% of the trading volume in the spot market. That is huge. That is a huge development compared to last year or any years prior. Most of the trading volume, 80% of the volume that's traded in the spot market typically is coming from traders, and that's churn, that's selling back and forth. Now we actually have an end user, essentially, which is Sprott, as 50% of the volume in the spot market. So that's significant. So when they're not in there actively buying, it changes the dynamics in the market. So what we had also was a couple of other things converging. One is that we were hearing that there were deliveries of uranium that were being carried by Russian tankers or by tankers that came from Russia, I should say, excuse me. So there were supposedly, and this is speculation based on, what I've heard from a couple of contacts, supposedly there was uranium material on these shipments that were coming from Russia that traders were unsure whether or not they were going to be able to take possession of that material because of its origin. And so they were trying to offload it, which hit the price. And then, of course, we also have month-end price manipulation that happens not every month, but really depends on the volume that's there. And it happens most months, I should say, is there's a number of traders. There's one in particular that they have forward month pricing of offtakes from producers that are priced based on the month-end closing price. And that will come typically on the last Friday of the month. So that was last Friday. And so we saw a big smackdown literally in the hours prior to that closing date and time for this particular trader. They get an offtake from Uzbekistan, and that, like I said, those forward month prices are based on that month-end price. So if the buyer, the big buyer of late, which is Sprott, isn't in there adding buying pressure in the market, it's very easy for them to come in and trickle sell a little bit of pounds here and there to drop that price down, which is exactly what they did. So once you know why it's happening, it's really not a concern. But when we went risk off across all markets, especially commodities, on the same day that the spot price was getting hit pretty hard, it was a pretty nasty end of the week last week.
Yeah, it's like a perfect storm for bad things to happen. Could this spill over though into longer term effects? Because it seems like a couple of bad things just gathered together, and to top all that, cherry on top, it was at the end of the month, so we get the end of the month slam, as you always discuss in the uranium market minute. But could this series of events, because it was gathered, could that spill over the sentiment of, say, the coming month or something? What do you expect?
Yeah, I think there's always some sentiment spillover for things like that, but not really long term. I think the biggest thing that would potentially have potential long term consequences was just the shipping issue. That's something that we're seeing continuously throughout all types of markets, and uranium is included in that. Is actual delivery of material and the source of that delivery is affecting the way that this material is bought and sold. So that continues to be an issue, and actually we don't expect that to be going away at any time soon. Things continue to intensify and get worse in the Ukraine from what we're hearing. So I don't think we're about to go back to normal anytime soon, unfortunately. And so there's a lot of risk associated with that material, and anything that's associated with Russia has a lot of hair on it. There's it's just it's a messy situation, and it's affecting these markets a lot. We've seen huge price moves in multiple elements of the fuel cycle. So for the month of March, we saw the price of conversion jump by over 60% in the month of March alone. That was huge. Now, conversion is the biggest bottleneck in the fuel cycle, and the fact that Russia controls 38% of global conversion capacity, it's not unexpected, or it's not a surprise that we get a move like that in conversion. What was surprising is we saw a 60% jump in the cost of SWU, which is the separative work unit, and the cost of long-term SWU, and that was a week-over-week jump. Now, those prices are reported, really only every week, and we had heard that there were some high prices being paid for long-term SWU in the weeks prior to that. But when the price jumped from $72 to $120 for SWU, for long-term SWU, that basically means that we're seeing increased new demand for enrichment that's coming from non-Russian sources. So exactly what we were expecting is actually starting to play out. And what we'll see now is a trickle down across the fuel cycle. So we'll see these prices in long-term SWU. We're likely to see the price of spot SWU make a big jump, and that's kind of the shorter term SWU. And then I would expect to see continued pressure on the conversion market. And the only way to get material faster through this process is to overfeed the enrichers. And that requires more UF6 and more U3O8. So it's only a matter of time before the knock-on effects of this squeeze that's happening in the later parts of the fuel cycle trickles down and affects the U3O8 market.
And it's that's an interesting point about the enrichment prices. I spoke to Brandon Monroe last week on Saturday, and he explained to me that the concept of overfeeding and how the spiking prices of SWU could actually cause for overfeeding, which just increases the demand for uranium. It just reinforces the thesis longer term, which is all great. And obviously these movements, intra-week movements, they're topical, so it's interesting to talk about them. But to be honest, if I don't have money to act on them, I don't really follow them that closely. I don't know if that's right or wrong, but I just feel like if I'm not buying, I'm definitely not selling at these levels for myself. That's what I've decided. So why would I bother going too much into it and stressing out? So if I don't have money, I'm not really looking into it. If I do have money, I might look at it a bit more in depth, but more company specifically as to, okay, what am I deploying some of the cash that I have left? So that's sort of how I approach it. What do you think about that?
Yeah, I do the same thing, honestly. Although I pay more attention to it because we're beholden to,
right,
our newsletter members. So I'm watching the markets every day, but in terms of watching every tick in the stock prices, I just don't really do that. Other than when, like you said, I'm looking at an entry or an exit. So yeah, and things can get just unbelievably noisy. So I'm largely off of Twitter on days when people are going nuts, which was last week, just because the noise is just deafening. We did see a decent rebound at the beginning of this week. We're continuing to see the broad markets kind of remain in risk off, going into closing the week out. The S&P and the NASDAQ and the Dow are all falling today again. So that has its effect on everything. But the commodities really got sold off hard last week, and uranium was just kind of the baby thrown out with the bathwater. In my opinion, there wasn't any real reason besides the spot price falling, which is what investors in this space watch and traders watch, right? So that did make sense, of course. But long term, I mean, things have only gotten really more fundamentally bullish, in my opinion.
Do you think that the chart matters on the physical uranium? Because pretty much the only decent chart that you can find would be the UX1, so the uranium futures chart. But if that matters, and you can tell me if you think that matters, but if it matters, it feels, or it looks like to me, it might be trying to fill a gap and fall below 50. So what do you think about that? Does that matter?
Short answer, no. It's a physical commodities market, and I don't really think that traders, because there's not really a futures market, The traders that are actually buying and selling uranium are not necessarily looking for example, like a gap fill on the chart. It has more to do with actual supply and demand that's going on in the market. With that said, you can obviously look at the charts and look at trends. And I think, yeah, the UX1 chart, I most of the time, I actually just look at the chart of SPUT, U.UN, which will actually give you a historical chart for when it was UPC. And even though they do trade, and UPC would trade at long-term significant discounts to their net asset value, whereas SPUT, 5 or 6% discount is pretty substantial. So for the most part, you're getting pretty close to NAV most of the time on SPUT. So it's in effect the spot price if you look at that chart. So that'll obviously show you the trends. But as far as the chart goes in implying where the price is going to go, and I don't really follow it in that way. I think that the physical commodities market has much more to do with just simple supply and demand fundamentals than it does charting.
I like looking at the Sprott physical uranium trust chart as well, because it's good for my heart, because it's been making higher highs and higher lows, and I like seeing that. It reinforces my belief that we're in a long-term secular bull market, to make it sound fancy, which means a bull market is gonna get it. Like Andy told me last week, a bull that is gonna try to buck you. You get ranging bull is gonna try and buck you. And as Rick Rule says, you got to be ready to take, on occasion, 2 to 3 50% downturns in your stocks. So, but as long as we're making higher highs, making higher lows, we're staying sort of in an uptrend. That's something that I like looking at. So yeah. Justin, back to what happened last week. You just told me that Spud bought 100,000 pounds. Is that all that they bought last week? That's not a lot, right?
They bought that yesterday.
Okay.
Last week, I think I don't remember exactly. Over the past, let's say 2 to 3 weeks, they purchased somewhere close to 500,000 or 600,000 pounds, if I recall correctly. Yeah, it's not huge. They've purchased 15 million pounds this year so far. So adding 100,000 pounds here or there is not big for them, but they're obviously just a monstrous entity here in the space that came out of nowhere. They're sitting on over 50 million pounds. And they came into taking over UPC with only 18 million pounds in their inventory. So what have they purchased? Is that 32? I think they purchased about 33 or 34 million pounds since August of last year. So 8 months. But they're going to go through cycles too. And the sector is going to go through cycles. And now, even though when they're out of the market, it has its influence on the market. Generally speaking, when SPUT's trading at a discount to NAV for an extended period of time, that's when the sector's kind of pulling back, and it's just going to do this. And like you said, those drawdowns are going to come. We had a 40 to 45% drawdown from November to late January. Then we had about a 15 to 20% drawdown in the past 10 days after being up. I mean, Cameco was up 50% before it pulled back from late January to last week. So it's been on a really good run. We're still in the green year to date, and that's pretty positive, especially considering that the S&P is down 12 or 13% year to date. So it's nice to see an outperformance relative to the broad market.
Yep. I'm gonna get back to the point of SPUT, but because we're obviously going to talk about the American listing. But before I forget as to what happened this week, besides the 100,000 pounds that they bought this week, I also wanted to talk about the ETFs, who it's sort of interesting to me that neither the URA nor the URNM issued any new shares. So what do you think that is, and what do you think that means?
Well, they're issuing shares when the ETF trades at a premium to their net asset value. When the flows coming into the ETFs are greater than the flows coming into than on balance than the individual holdings themselves. So later at the end of last week, URA actually did issue a couple 100,000 shares, and then there's been small redemptions in URA the past couple of days, really small, like $5 or $6 million, almost nothing. So the selling basically is not coming from the ETFs. So basically what that means is you're not seeing massive amounts of institutional selling of the ETFs, taking them down to a significant enough discount to NAV to where they would actually sell their holdings and redeem shares. So very small amount of that for URA. And if you were to zoom out and look year to date, the share issuance has been astounding. There's been $750 million in purchasing by the ETFs from their share issuance this year alone. So bigger picture flows continue to come into the ETFs overall. We're going to have days, they've been mostly flat for the past week or so because they did issue some shares and then they redeemed some shares. But, we're going to have these quiet times in the market here and there. So usually when we see big share issuance in the ETFs, that's typically the same time period when SPUT's trading at a premium to NAV. They're raising a lot of money. They're buying a lot of uranium. And it all just kind of, that flywheel, it all just moves in unison when the sector is moving up. And then when it goes quiet, the sector pulls back. And we're just in, one of those quiet modes for the past week or two.
Mm-hmm. Who do you think is selling if it's not the ETFs or institutions?
Well, I don't think the institutions were selling heavily selling the ETFs heavily. I think that there definitely was some institutional selling last week, and that probably had to do with just simple deleveraging, going risk off. We had a number of large commodities companies have earnings last week where they reported where the market did not like what they basically their projections in the earnings calls. So companies like Rio and BHP, there were a number of other larger commodities companies that were basically saying that their production levels were down due to labor shortages and supply chain problems. And so that kind of led to a little bit of a risk off. And when those big boys start getting some selling, the institutions that are holding those might also hold a little bit of uranium, a little bit of URA, a little bit of URNM, Kazatomprom, Cameco, NextGen, the big caps. So it felt to me like a liquidity thing. It wasn't uranium specific. It was just a liquidity thing. So it looked to be just deleveraging. And then of course, retail gets spooked whenever there's selling, retail gets spooked and starts selling along with it, especially when the spot price drops like that. Just kind of snowballs.
Do you think there's a lot of algo activity? Because I know that algorithms tend to sell on news titles basically, and as we said, it's been a perfect storm to sell off uranium. So if it's been an algo activity, do you think that's possible?
I imagine there's some of that. I don't think it's the majority. I think it's the majority of the selling. I think most of the time, or not most of the time, but last week in particular, was probably retail, but it was spurred by, in my opinion, some institutional selling, just going risk off and deleveraging. But we also saw URNM became the Sprott Physical Uranium Trust this week. And so, the Sprott Uranium Miners ETF, that takeover officially happened. So it was interesting to see the selling happen right before that. I don't know. People were speculating, oh, isn't that convenient? Now Sprott can give their clients an excellent entry after a 10, 15% sell off. Who knows? That's not my bet, but
yeah. It's honestly, I like conspiracy theories, and I like to believe that rich people are always trying to do something to us, but I cannot confirm it. So is there really sense into going more in depth into that? I don't think so, but it's an interesting thing to think about. Let's maybe then talk about the obvious news here. The SPUT, New York Stock Exchange ARCA listing, it got denied. So they're not listing on a New York Stock Exchange. I guess not to assume too many things. Could you just explain to me why that is and what that means moving forward for the sector?
Sure. Yeah, my understanding is the primary reason had to do with an exception that was requested by the New York Stock Exchange on behalf of the Sprott Physical Uranium Trust for the SEC to make with a redemption clause. So the other physical trusts that exist on the NYSE have redemptions. So what that means is if you own X amount of shares of the Sprott physical silver trust, you can actually exchange those shares for actual physical metal. For obvious reasons, you can't do that with uranium. And so there was a request by the New York Stock Exchange for the SEC to make an exception to that clause. And the SEC basically said no. So, that's really the long and short of it. There's other things that I think had somewhat of an influence, which were that there isn't a highly transparent, frequently updated price for uranium that the market can watch. You have the spot price that's reported whenever a trade is made, but it's not like watching oil futures or something like that. It's much more opaque. And so that seemed to have some effect. And then there was some note about concern about the physical uranium market. If that is true, the SEC, they don't know a damn thing about the physical uranium market. So likely they had somebody in their ear, most likely utility lobbyists had some influence on it. So, we knew from the beginning that there was a chance that this could happen. I did believe that they were going to get it. And that for me came primarily from confidence that was coming from Sprott CEO, John Ciampaglia, who was also confident that there was a good chance they could get it. But at the same time, if you look at the flows, large funds are not having any problem finding on the TSX. I mean, they've raised almost $2 billion in 8 months. It's really not, they're not having a problem finding it there. It would have been gasoline on the fire, but the fire by no means is gone because of this. So it's kind of a nothing burger. It was a bit of a disappointment. There was a small amount of selling based on that news, but honestly, that recovered in the same day, and the stocks in the space ended up closing mostly green on the day that news came out. So really not a big deal. It would have been nice. I was sort of salivating at the idea of a listed options market for SPUT, but not looking like that's not going to happen. So we'll just have to have to be okay with the existing trust as it is, and the funds that are flowing into it as it is, which is phenomenal. I mean, nobody expected this type of vehicle to even exist a year ago. So the fact that it's here and they're buying what they are is unbelievably positive for the uranium market.
I think that so obviously you're right, but I think it was it was really heavily promoted and marketed, the vehicle. And so it brought a lot of new people on. It reinforced a lot of people's belief and stuff like that. So I can imagine this has shaken some of the sentiment. Also because, an American listing would have increased liquidity and likely the volume too, which is what those larger players would really want. And so I find it interesting that it would be it wouldn't mean too much, because this used to be thrown around a lot as one of the bigger catalysts basically in the space. I think you mentioned it a couple of times though in your uranium market minutes. I do follow those closely, so I think you mentioned it a couple of times that you would think it's nice, but you're not going to sell out if it doesn't happen. So it's not going to be the end of the world. I think you've mentioned that multiple times in the past, but as this was mentioned a lot of people were hoping on it. And now that it's not happening, and now that they don't even, I think they don't even intend to try again to list in the US for the time being, we've sort of seen the sentiment drop at least a little bit. So it seems to me like the whole day-to-day or maybe week-to-week movement in uranium is heavily dependent on what's happening at Sprott. So not necessarily the SPUT and this listing, but just like Sprott in general seems to be a heavy sentiment mover. Is that something you think is true, or how do you look at it?
Yeah, they become a major element of this market. That's for sure. Yeah, I mean, I'm not going to try to spin it in a positive light. We would have liked to have seen it, but at the same time, it is what it is. It's not a reason, in my opinion, to sell, because look what they've been able to do. If they would only had purchased, a few million pounds and were struggling to raise money, and everybody was hinging their investments on a hope that they would get this listing, that's one thing. But almost $2 billion in 8 months, and they purchased 34 million pounds of uranium. That's insane. It's insane. So there's no doubting what they're able to do. You also have to wonder, how much marketing have they held back on until clarity around this situation came to pass? I don't know. And that's not something that I'm sure Sprott would even be comfortable talking about. But it's something you certainly have to wonder. It wouldn't have made sense for them to hammer their clients with marketing of now their ETF and this SPUT vehicle while they're in the review process of the SEC, knowing that they would be hearing from the utilities, that the SEC would be hearing from the utilities. They're not about to just slam the market and buy as much as they can, make the price go on a moonshot. So we'll see. Maybe we'll see, the sentiment that turned down because of that's going to turn right around as soon as the buying starts again. So, retail is always chasing the next shiny object. Everybody's now hinging on what Cameco is going to say in the conference call next week. and just waiting for the next catalyst and the next catalyst. And that to me is just exhausting. I stay on the big picture. Obviously these elements matter, but thinking about the big picture is where we're at. Somebody messaged me something that I thought was really interesting regarding the SPUT NYSE listing, basically saying they're really, really happy that they didn't get the listing. And here's why. The idea of a much more liquid, much higher volume amount of funds going into SPUT, leading to much faster purchasing of SPUT, would basically lead to a much faster purchasing of physical uranium, to the point where SPUT would go on a moonshot so fast that this bull market could potentially shoot up and fall much, much faster, to the end that the equities might not be able to keep up. And we've seen that happen before in other commodities. We just saw that happen in nickel. Sure, a number of nickel stocks did really well during that run up, but the commodity went on an absolute moonshot so fast that it actually cratered the market that it was trading on. And the equities just couldn't keep up. So I thought that was a really interesting point. Could this actually be a positive thing for a healthier, longer term bull market? I think that it could. That was a really interesting point that got me thinking.
Or to the end that there was no time for amateurs like myself to exit. I mean, if there's a moonshot, even if the equities follow, who are you going to be selling to if everybody's trying to exit on that moonshot? And you end up not selling, not being able to sell at the price that you were hoping, especially consider that like my portfolio is heavily focused towards like the smaller market caps. I'd much rather average out over time. So that's something that we've always talked about with you as well, that I don't really want to see this spiking. I did want to see an improved longer term sentiment and more institutions coming in. So something else that was sort of concerning to me in the first place, I did think a little bit about it, but it was that, maybe I can ask you this as a question. Do you think that the grounds on which the request was denied to list on the New York Stock Exchange, the SEC basically said that the pricing mechanism for physical uranium are not okay for the big leagues. That's what it came down to. Again, you said that doesn't really make too much sense as they don't know too much about it, but that's what they said. But do you think that the fact that they mentioned it could repel larger institutions from entering on that same ground? Institutions that maybe don't know too much about uranium, but are generally investments in like growth investments or something. Could this keep them away from the market because of what the SEC said, basically?
No, I don't think so. I mean, and I don't really know how many funds were watching this story, waiting for the New York Stock Exchange listing for an entry. I do know that there are funds waiting to position in uranium simply based on liquidity. So to that tune, yes, we would have seen larger funds take positions sooner on a New York Stock Exchange listing because the liquidity would have been immediately improved.
Yeah.
But I don't think really what the SEC said has any sort of negative connotation surrounding it. Yeah. It's primarily, the primary issue is the redemption. They wanted to see physical funds and physical trusts should have a redemption mechanism in their eyes. And because you can't do that with uranium, that was game over for them.
Yeah. I was just sort of wondering if it's going to be, somebody watching this from the sidelines and being like, hey, if the SEC is not touching this, I'm not touching it. I don't know if anybody ever said that, but it could be a thing. Okay, but considering all of that's happening, because there's a lot happening in the uranium market, would you? I watched an interview with Rick Roll. Who did that interview? It was just very recent. I don't remember. Shout out to the person who did it.
Interview, maybe.
What's that?
Maybe it was Jake Ducey? He just didn't.
Oh, it could. Yeah, it could be. Yeah, the guy with the long hair, and then he had short hair. Right, Jake. Right. He said that we were in the 6th inning, I believe. Rick Roll, would you agree with that, or do you think he's a little?
I did hear that. Well, I thought it was really funny because in his investment boot camp, which I participated in, which happened just a couple of months ago. No, excuse me, that happened last month. He said it was the 2nd inning. So apparently we've gone through 4 innings over the course of 35 days. So I don't really know. No, I don't think we're in the sixth inning. I think we are closer to the first. Let's say we're in the first half. I would say we're probably in the second or third inning. I don't really like these analogies that much, to be honest with you, because it's always impossible to say. Who knows what sort of exogenous events could extend this market or make it shorter. But we are clearly, I mean, the sixth inning is when you're getting ready for a blow off top to happen in the seventh, eighth, and ninth, when you make, most of your gains in those last couple of innings. And I don't think we're there yet. I think the broad markets risk off and things going sort of quiet. The pullback we had from November, that sort of did a little bit of a reset, which I think was long-term probably healthy. But no, I think we have a ways to go. I don't think we're on the doorstep of the last final big move. Of course, I could be wrong. Things could change and we could just go on that moonshot, next week. I mean, who really knows? It's a flow of funds story now. And that's really what's going to move this more than ever. Of course, the fundamentals are in place in the background, which is, what gives us the most confidence. But it's the flow of funds really that tends to move these things. And I don't think we're in the sixth, but I also am not totally sure we're in the second, maybe the third.
Okay. Then he also talked about, now what he said really hurt me emotionally, because he was talking about the explorers, and he specifically mentioned the $50 market cap explorers, which is sort of the thing that I was focusing on. He said that they were heavily overvalued. I know you don't do those in your newsletter, but some of those stocks have been underperforming stuff like Cameco. I mean, Cameco has been an extraordinary performer. So wouldn't you think that even if those smaller market caps are expensive from a value perspective based on what they have, wouldn't you think that they may still outperform in a later inning or a later stage of this market, or whatever you want to call it?
Sure. Yeah. I mean, it depends. It depends on a lot of factors, but that potential is definitely there, especially for explorers that are moving forward with their projects and actually making some semblance of discoveries. If you have a small cap explorer make a good discovery during a bull market, then absolutely that will outperform pretty much anything. But explorers as such, I mean, they really need to be able to move their company forward. I mean, there's a couple that I'm watching that, there's one in particular I don't want to mention by name, but the explorers live and die by the drill bit. That's the hard part, right? It's a tough business. So they're out there poking holes in the ground trying to find something. And if an explorer just has repeated poor drill results, then it's likely to underperform the likes of Cameco. So and they need to get up to a certain level. You have to hit something, and you got to hit something kind of early. That's the problem with the exploration companies, because if you go years and years and years without hitting, the dilution gets insane. You have to keep diluting. If you're a $20 million market cap company, you need to raise $5 million for a drill program. It's like, you got to dilute by 25%. That's a big deal. And if you got to do that every year for an exploration program, your share counts can just get away from you. So there's a lot of pressure on explorers. It's a tough business. There are some good ones out there. It's possible that one of these small cap explorers will hit something, but you got to get at least up to that threshold for ETF inclusion if you want to play along with the whole rising tide lifts all boats sort of thing. So if you're small enough to stay excluded from the ETFs and you haven't hit something of significance that the market at least slightly appreciates to bring some flows into your company prior to being held by the ETFs, then you kind of it's tough sledding.
It sounds to me like you're saying that it's maybe even more important to focus on the geology and the positioning of the company, where they are, who's trying to drill, has there been any uranium found there before, and stuff like that, more than you would have to focus on the macro picture of uranium if you're specifically targeting explorers. Because even if, there was sort of this correction these last few weeks, but even if you're in a bad correction, if an explorer who didn't have uranium before hits uranium, the stock is going to take off regardless of the market. And so that's maybe is that what you think that's fair to say?
100%. Yeah. Okay. If explorers are your game, you got to do your own work on on the drill team, on the history of management, and especially on the land packages and the targets. Yeah, which is a very, very difficult game. There's very few people that can do that type of analytical work on deposits to be able to see something that the market does not in position prior to that discovery. Very, very difficult to do.
Right.
Some people do it extremely well. We don't deal with that primarily because A, we don't like to play on that gamble. And B, we need more liquidity than the small caps can offer at this point. So, right. But yeah, I mean, explorers, it's much more of a gamble, but man, if they hit, it can be quite the ride.
Yeah, that's true as well. It's a completely different game. I don't even see it as much as a uranium bet as something like a mid-tier developers, something like. I don't like the big caps as much as I like the developers, because they have especially the ones who have a decent chance into getting into production this time around. I think those are really the bets on uranium, sort of a mid-range where you want to be. And I think that's exactly what you cover in the newsletter. I'm not going to say any names, obviously, out of respect for your paying members. But so yeah, it's a completely different game. The explorers, you're betting on something else. A little bit on uranium too, but I think that some of the companies that, for example, you cover could eventually outperform the explorers, regardless of the explorers having a tight share structure and a low market cap, if the explorers never hit anything. So that's sort of the way that I'm looking at it. But okay, yeah, you also mentioned that the chemical coal is something that you'd be watching going forward. What else are you looking out for? What's the most important thing that you're paying attention to in like the coming months over this summer?
I mean, we always watch the chemical calls or listen to them, despite the fact that I have to get up at 4 a.m. to do so. So that's obviously coming. We're watching out for follow through on ANU Energy's promised follow-on $500 million raise. That's the physical uranium fund that started up in Kazakhstan. And so that they had a $50 million initial seed raise and purchase uranium with that. And they expected a $500 million follow-on. From what we're hearing so far, that is expected to happen this year. So we're keeping our eye on that. We'd like to see the inventory numbers come from the US utilities. That'll come next month. We attended a virtual conference that took place in London 2 days ago. That was the World Nuclear Fuel Cycle Conference that the WNA put on. And there were some really interesting tidbits that came out in that conference. One of the most noteworthy was a representative from the IAEA, International Atomic Energy Association. And she basically shared some slides and shared a study that the IAEA did that is showing the inventory levels are significantly lower than they have been in recent history. So the US typically will have a minimum of, on average, 2 years of inventory. Europe will have, on average, 3 years plus for just security of supply reasons, right? National security reasons, oftentimes. And so we've expected the US utility inventories, for example, we've expected those to decline over the past few years because of what we noted was, lower than usual term volumes, term contracting volumes. And so it's like, oh, well, the spot market didn't do, extra volume. The term market's still really quiet. Their inventories didn't move. How is that? So they've been buying a lot in carry trades over the last 5 to 10 years that are not necessarily spot market transactions, and they're not necessarily term contracts. So they've been able to bolster their inventories year over year for quite a while and remain at relatively stable inventory levels, even without large amounts of term volume contracting or spot market purchasing. So what does that mean? That means that the study that she shared was showing that on average, the US utilities have around 16 months of inventory. And so that's significantly lower than last year. That's significantly lower than previous years. Which is quite interesting. And another point related to that was that the bulk of, so the on average, right? So some utilities have 5 years of inventory, right? Some utilities have less than a year. On average, that was less than 2 years, 16 months, but 40% of the utilities in the United States have the bulk of the inventory. So what that means is 60% of the utilities in the US have below that average, of 16 months. So basically what that means is there's some buying that's going to need to happen. And we think that the reasoning for both the EU and the US utility inventories to drop like that, these aren't official. This is from a report from the IAEA. So these are not official numbers that will come in May for 2021 from the EIA in the US. This is from a study from the international agency. We believe that is because the utilities are largely sort of standing back here, kind of waiting to see how this whole situation in Ukraine plays out. We think that we saw a lot of contracting to Cameco in the first 5 weeks of the year, as they reported 40 million pounds that they had contracted in the first 5 weeks, which was more than they contracted the entire previous year. But the term market has gone pretty quiet since then. And so we're not expecting Cameco to report, another 40 million pounds, let's say. I think that they did sign some more since then, but those volumes dropped off. So I think that utilities are kind of like sitting back right now, drawing down some inventory. Some of them are securing contracts. Some of them are, the buying in the spot market is negligible on the part of the utilities. It's mostly mid and long-term contracts. But for the most part, they're sitting back right now, drawing down inventories and trying to figure out what the heck is going on with this market and how they're going to move forward. There's a lot of spinning parts. There's a lot of concern about a supplier that the U.S. utilities absolutely love doing business with in the past, and that's Russia. You could go and get the cheapest uranium around, and you could buy your U3O8 and your conversion, and your enrichment, and your fabricated fuel from one seller. And it was a one-stop shop, and they loved it. So the fact that that is now essentially off the table, not officially, there aren't official sanctions yet coming from the US or the EU or from Russia in terms of cutting their deliveries. It's all still technically available, but the language is getting increasingly severe, let's say, in the US. I think that it's a matter of time before we have actual sanctions on Russian uranium. And the utilities are positioning prior to that. They don't want that concern. They don't want that in the back of their minds, thinking a delivery they're expecting 2 or 3 years from now is going to get cut off at some point between now and then. So they're seeking pounds elsewhere, as we've seen with that long-term SPUT price jumping. But those inventory levels were definitely noteworthy.
Exactly. Must have, and it's also knowing that, because it's sort of a big question mark for a long time. So that's good information that we've gotten. Yeah, I don't really have any other questions. There's something that you wanted to add, Justin?
I don't think there's anything really all that specific that I want to add, other than I know that there's a lot of retail investors that watch my channel. There's probably a lot of retail investors that watch your channel. It really can be helpful in choppy markets to just zoom out, to look at weekly charts. Some charts I've been looking at recently that I think are very helpful are to look at relative charts. So I will look at a chart of URNM relative to U.UN, or the Sprott Physical Uranium Trust, basically the miners versus the metal. And there's some very interesting trends that you can see on that chart. And this is, historically speaking, in terms of that chart, a very good time to buy miners relative to the spot price. And then I've also been looking at 2 other charts. One is URA relative to the S&P. And if you look at a weekly or monthly chart of that, it's pretty astonishing. I mean, we are in the very early innings of an outperformance of the broad markets, but an outperformance we are definitely in. And you don't always feel that on days like today or days like the end of last week. But if you zoom out on the charts, you can clearly see that we are outperforming the broad markets, and that trend is very, very early. And lastly, a really interesting one that your listeners should bring up is URNM relative to URA. And that's a really, really curious looking chart. So URNM, as you know, is a pure play ETF, 100% allocated to uranium miners. Yeah. URA is 70%. So it holds, BHP and Samsung and Rio and a number of other stocks that are not purely, exposed to uranium. And so what you've seen is when the sector pulls back, URNM pulls back more than URA. And when the sector moves up, it outperforms URA. Since its inception, URNM has greatly outperformed URA over the past, just over 2 years. And every time the sector pulls back, that chart goes to its 200-day moving average before we make our next move up. We're right on that 200-day moving average right now. Really, really cool looking chart. So my suggestion is to A, zoom out, B, try to ignore the daily noise because it's unbelievable deafening on most days. C, definitely do your work in terms of due diligence on companies in the sector as a whole. And D, I would say you have to really know what you own and why you own it, because the volatility is like nothing else. It's maybe cryptocurrencies are as volatile or slightly more volatile, but compared to every other asset class, I mean, nothing beats uranium in terms of volatility. So it's very difficult to stay on in a bull market. We are in a bull market. We will continue to be in a bull market, at least for the time being. So make sure that you know what you own, why you own it, and that helps to stomach the volatility.
Absolutely. And to bring in a little bit of survivorship bias, I would say No Goods, No Glory. It's a book that Adolf Lundin wrote. And unfortunately, that book is like $1,500. So that's not something I'm going to buy because it's some sort of a collectible. But the title of it really sticked with me. No Goods, No Glory. So
you can't have the outperformance on the side of gains if you don't have the volatility to the downside. So you cannot have one without the other. So most people are in uranium because they're looking for multiples on their investment. They're not looking for a 7% return on an annual basis. They're looking for a 5x in 2 years or something like that.
Yeah.
So if you want that, you have to be ready and prepared for these drawdowns, either to hang on through them or have cash ready to deploy, because they're going to keep happening. We're going to have another leg higher and it's going to pull back again, regardless of how great everything looks. But yeah, you gotta have volatility to the downside if you want the outsized gains on the upside.
Moving on, there really isn't much that I can add to the uranium part of the conversation here. This was a good overview, I think. So let's talk about geology instead, on the hand of 2 news releases from companies that I follow as a case study, and a fair disclaimer.